Let's unpack that, first of all. The probability that Trump actually cut spending. When you look at the range of campaign promises that he made, it's obvious that he wasn't really campaigning on cutting spending. He was campaigning perhaps on cutting spending to constituents that didn't vote for him, but that's not the same thing. If you were as old as I, and I realize you're not, you would have experienced this once before during the Reagan Revolution. Reagan came to office with a much stronger mandate than Trump to dismantle government, reduce the size. There's a wonderful book called The Triumph of Politics by David Stockman that describes the derailment of the Reagan Revolution within 180 days of them taking office. Think about empowering a government agency, the Department of Government Efficiency. Yes, you're creating a government department to reduce government departments. Think about that. The probability of them achieving that, I believe, is zero. As to your first question, how do we get out of this? I think, unfortunately, the answer to that is clear from history. We face the same circumstance, although less dire, in the decade of the 1970s. And what we did is we honored our nominal obligations. In other words, some old codger like me, who's getting $4,000 a month in Social Security, I'll continue to get $4,000, but $4,000 won't buy $4,000. We will honor the nominal amount of our obligations, but we'll inflate away the net present value of the obligations. The US government themselves suggest that in the decade of the 1970s, the last time we faced this circumstance, the purchasing power of the US dollar was reduced by 75%. Not coincidentally, during that period, the gold price went from $35 an ounce to $850 an ounce. Yes, the two events were related. The only way that I understand that we get ourselves out of our debt crisis while politically honoring the nominal value of our obligations is to inflate away the net present value of those obligations. Sadly, in this circumstance, I believe that past is prologue. I also believe, unfortunately, that most Americans aren't even aware of the narrative around the problem, never mind the arithmetic. I believe, just from talking to people, that people's expectations of the future were formed over the last 40 years. The period 1982 to 2022 was, in financial terms, particularly for Americans, but also for Canadians, probably the easiest times in humankind. The nominal interest rate, the real interest rate were falling. The US government was able to export inflation to other countries because of our currency. We had the benefit of the good parts of globalization. We had the benefits of world trade. Unfortunately, I think most of that came to a screeching halt beginning 2022. I'm struck that most people don't understand the difference between solvency and liquidity, which is to say somebody who has a $700,000 home mortgage, $100,000 in credit card debt, whatever it is, they're making $70,000 or $80,000 a year. If they have $10,000 in their jeans, they can afford today's bills. They're maybe going to lose their house. They're maybe going to go upside down in credit card debt, but today they can buy a hamburger. I would describe the circumstance that we're in today as that same thing. We're confusing liquidity, the fact that there's cash in the system, with solvency. The second thing is that we are in an economy that is doing reasonably well. It's just not doing reasonably well for most people. If you're Rick Rule and you have access to credit, credit's artificially cheap, and if you understand how to use the credit, this economy, for people like me, is spectacular. This economy, for people who don't have access to credit or don't know how to use credit, people who are more focused on their lifestyle and on their family than they are their finances, this economy is not working for them. And we need to understand that there is a human cost to the economy that we're in, irrespective of the fact that the headline numbers are pretty good. And society's going to have to deal with that. I suspect the surprising beneficiaries will be both the U.S. and the Canadian oil and gas industry. I think that Trump will dismantle the de facto regulation around the transmission of oil and gas in the United States and the construction on the East Coast of natural gas liquefaction facilities. That's important for Americans because right now we're producing a lot of gas as a byproduct of oil, more gas than we can store or sell. That same gas, which is priced at Henry Hub at $2 US or at AECO for $1.50 Canadian, that same gas sells for $10 US, 13 Canadian dollars as liquefied natural gas in Rotterdam, in Shanghai, and Tokyo. The ability to gather that gas, process that gas, store that gas, ship that gas, liquefy it, and deliquefy it is what changes that $2 a million BTU into $9 or $10 a million BTU. It's important that Canadians understand that although your Prime Minister doesn't see a business case for Canadian natural gas in Europe, Europe and likely will not allow liquefaction or transmission infrastructure in Canada, it's very likely that President Trump will. And the ability of producers in the Western Canadian Sedimentary Basin to ship liquefied natural gas through BC, that's already underway, to Asia, but also ship Canadian natural gas through the U.S. to ports on the Atlantic coast of the U.S. Even though it would be more efficient to load that gas in Quebec, that'll be important for Canadians. If the electorate in Canada changed their mind and allowed Mr. Trudeau to pursue other employment opportunities, that benefit might come. With the oil and gas prices falling, I've begun to increase my already sizable positions in oil and gas. The change has been that over the last 2 years, my allocations have favored the big U.S. producers, in particular Exxon, Equitable, and Devon. My focus now is north of the border, which everybody hates. So names like Freehold, names like ARC, Tourmaline, Peyto, Birchcliff, very well-run companies, management teams who I've known personally for 30 years, commanding positions in the Western Canadian Sedimentary Basin, lots of great undeveloped locations, strong balance sheets, and hated, decidedly out of favor. To me, that's just a wonderful cocktail. Gold has done a great job, and I'm delighted. In the year 2000, it was at $253 an ounce. Now it's at $2,600. In other words, it's up, sevenfold? Gold has increased by almost 8.5% compounded for 24 years. It's done exactly what it was supposed to do. It's protected by purchasing power for 24 years. So when you're asking me when gold's going to move, 24 years ago. What I really like about it from an investment perspective is that it has this wonderful track record, which nobody cares about. The market share of precious metals and precious metal securities in the U.S. market, the market that I know the best, is less than 0.5% of savings and investment assets in the United States. The 4-decade mean, according to JP Morgan Chase, not some old bald gold bug, is that the market share of precious metals and precious metals securities over the last 40 years in the U.S. market has been 2%. Gold doesn't need to whip the U.S. dollar. Gold doesn't need to break the Treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the U.S. market grows fourfold. Now, can you imagine what a fourfold increase in demand for gold and gold stocks in a market that controls 23% of the savings and investment assets in the world would do to the gold price? I mean, it's a stupid number. I don't own gold because I think it might go from 2,600 to 3,000. I don't own it for that reason. I own it because I'm afraid it's going to go to 10,000. I own it because gold historically has been a store of value during periods of time when people were concerned about the maintenance of their purchasing power in fiat instruments. And when I consider the debt problem that you and I just discussed relative to the national income, I don't believe there's any way in the world that the US dollar can maintain its purchasing power. That's why I own gold. Do I know or care if it's going to $3,000? Not the faintest concern, not the faintest interest, neither. I own gold because I don't understand arithmetically how it can't go in nominal terms to the next digit. Bitcoin is what, a $3 trillion asset class? Robert Friedland describes that as a pimple on an elephant's ass. It doesn't matter. I mean, yes, on the margin, right? Penny stock moron and the crypto moron are very similar species. But if you look at a global market for savings and investments at the $750 trillion level, gold is a sideshow and Bitcoin is a sideshow. They don't matter. The circumstance that will cause the gold price to move is a circumstance where perhaps Bitcoin can be accommodated in the move too. My suggestion is that they serve different purposes. Gold is a store of value and a medium of exchange. Bitcoin is a network and a transfer mechanism. Right now, they're regarded as momentum. They're regarded as trading vehicles. I engage in conversations here with people about Bitcoin. The real knowledge they have is that they've watched it go from 1,000 to 100,000. That's the whole knowledge. And the fact that the asset class is up 100-fold, they somehow think makes it more attractive. So let's say that your fiance went to the grocery store and the price of bananas was up 100-fold. She would be very logical and not buy bananas. But because an asset class is up 100-fold with no demonstrable change in utility, why is that good? I suspect that price information is easy for people to obtain and hence it becomes valuable. If you ask people to form an opinion as to value, they have to do work. They have to think, not feel. And perhaps most people would rather feel than think. I'm out on a limb here. I don't know the answer. I look at things like the aggregate debt of the U.S. government and the ability to service the debt, and I'm concerned. And I express that concern from the podium here, and I watch the audience stocks nod off, saying, would you please give me 5 gold stocks that will triple in next quarter? I don't care about the state of the world. We talked earlier about the unfair division of economic gain. It's unfair because some people work harder, take more risks, and think better. That's the way it works. Sadly, people resent that outcome.